Welcome to a video demonstrating the development of a balance sheet in publishable form from the accounting worksheet. Here is an accounting worksheet similar to the one that we did in a previous video, but there's a lot more accounts on it, a little more real-world-ish. It is completed all the way through the process, by the way. Notice I don't have individual columns for income statement and balance sheet. I could have a column for financial statements, but in reality, once we know what we're doing here, we have everything we need from the adjusted trial balance column. I know what the permanent and temporary accounts are, and you do too at this point. So in the real world, you won't always see those columns, and thus I didn't put them in this video. Okay, so again, we have the Racket Sales Corporation accounting worksheet at and for the year ended December 31, 2024. And this was, of course, provided to you as a lead into this case. So now at this point, go ahead and turn those permanent accounts into a balance sheet. And go ahead and pause the video. And when you're done, come on back and we will take a look at it together. All right, thanks for your attention, and I'll see you in a few minutes when you're done with the balance sheet. All right, welcome back. And hopefully you have a nice looking balance sheet in front of you. Here's mine. We have the title, as always, the first thing you do, Racket Sales Corporation, balance sheet at December 31, 2024. And keep in mind, we would also have 2023 here, which would simply be the balance sheet that we prepared last year in the same way from a very similar accounting worksheet at the end of last year. In the real world, it's likely just the previous tab in this Microsoft Excel group of accounting worksheet tabs. All right. And so when we start, we start with the assets of the company at the top of the balance sheet. All right. And so that brings us to our worksheet. And we have cash. We have two accounts of cash. We have the account number for cash is 100. And then we have dash T, meaning it's the tennis division, and dash R, meaning it's associated with the racquetball division. There are two divisions in this company. And the total of the cash between the two is $1.745 million. And that becomes the first line on our balance sheet. And by the way, I put another subtitle here that we're going to start with the current assets. And that's consistent with our habit to say that we will put them in the order of the current assets and then the non-current assets. And there's cash. In a similar way, the next two lines on the accounting worksheet have accounts receivable payable to the tennis division of $9,000 and payable to the racquetball division of $1,000. So that's a total of $10,000. The next two lines are short-term notes receivable. There's a $20,000 note receivable due to the where the borrower has to pay the tennis division. There is not one at the racquetball division. Oops. I put those in a different order. Inventory. That's actually if you put short-term notes receivable and then inventory, I would say you did it better. And then we have, it doesn't matter completely, but if you have, I would in retrospect put this up here. And then with inventory, we had inventory of 25,000 at the end of the year at the tennis division and 5,000 at the racquetball division. And that is the end of the current assets because, of course, in the adjusting journal entries, we expensed all the prepaid rent and we haven't paid the rent for 2025 yet. And so total current assets is the sum of these. The Greek letter sigma is used for sum, and if you add those numbers up, you'll see that they come to 1,805,000. Going to the non-current assets, the first non-current asset is the showroom equipment, and it's 50,000 at each of the units. So there's 50,000 of showroom equipment associated with the tennis division and 50,000 associated with the racquetball division, or 100,000. The accumulated depreciation related to those two accounts is 40,000. So they're about 80% depreciated. They're about 80% through their useful life, probably. And so the net equipment is 20,000. The showroom equipment net of depreciation. And if we look at the worksheet now, the next account here is a 200 level account, accounts payable. Well, that's a liability. So I think we have all the assets shown. And so we have the subtotal for non-current assets of 20,000 and total assets is 1.825 million. And that's the asset side of our balance sheet. Let's turn our attention to the liabilities. And again, just like we started with the assets, we started with current assets, we start with current liabilities and accounts payable, which is there's an $1,000 account payable to a vendor associated with tennis and nothing at the racquetball division. So the sum is 1,000 in those two accounts. The interest payable is 10,000 at the tennis division, and it's actually I have to look at this closer. I might have them out of order here. The interest payable is actually 10,000. We have to pay attention to the account titles here associated with the racquetball division and 2,000 associated with the tennis division. So that's a total of 12,000. Income taxes payable is 102,000 associated with the tennis division and 10,000 associated with the racquetball division's profits for 112,000. And our total current liabilities are 125,000, much less than our current assets. So we're in quite a liquidity position. Maybe too much. We have a little too much cash here. We're cash heavy right now. We could deploy that cash and build our business. But boy, we sure are no liquidity risk. And then the long-term liabilities. We have two long-term liability accounts. So they're both notes payable. And it's 100,000 at the tennis division and 20,000 at the racquetball division for a total of 120,000. And that gives us total liabilities of 245,000. 125,000 plus 120,000. Total liabilities is 245,000, quite a bit less than the total assets. So our equity is going to be 1.825 million minus 245,000, and it breaks out by the common stock, which is $14,000. And the paid-in capital in excess of par of 208,000. And retained earnings is up to 1.385 million at the end of the year. I had to close our income this period into retained earnings, and so it is at 1.358 million. And so now our assets equal our liabilities plus shareholders' equity at 1.825 million. And that's a balance sheet for the company. And that's what it looks like from when you can see the whole thing. Still can't see it, but get the point. Okay, and that's a balance sheet. And I appreciate your attention. Hopefully you had done that and yours was quite similar. If yours looks similar, but not exactly the same, that's okay. There's no, the only dictated rules in here is that the tradition is that in US GAAP, we put the current assets before the non-current assets and the current liabilities before the long-term liabilities. Okay, that's the balance sheet. Thank you for your attention and have a great day.